Welcome to the Perpetual Investor. Keep your powder dry and wait for the crash is the most repeated advice on financial social media. But when you look at the historical data, the math simply does not back it up. Today, we are putting the buy the dip strategy under the microscope, and we will show you exactly why waiting for a market crash is simply not an optimal investment strategy. Let us set up a realistic scenario. Imagine two investors saving a portion of their income every month. The first investor is the market timer. She hoards her cash, waiting for the market to drop so she can buy the dip. The second investor is the monthly buyer. The moment her paycheck arrives, her money is automatically invested into the market, regardless of the price. We hear these theories all the time, but we do not like to trust the noise. We want to see the math. The fundamental rule is this: once you find a set of instruments you trust for long-term returns, your only job is to acquire them consistently. To prove this, we built a custom Python simulation to test this exact scenario on the S&P 500 over a 10-year period. We pitted our constant buyer, the monthly buyer, against a mathematically impossible character. Let us call her the Oracle. The Oracle does not just wait for a dip. She has a time machine. She holds her cash in a daily interest account, wait for a market drop, and then she deploys all her money at the exact, absolute bottom. Flawlessly, every single time. So, what happens when a boring, systematic investor goes up against a psychic market timer? Let's initiate the simulation. The monthly buyer, represented in blue, holds zero cash in reserve and systematically invests $500 into the index every single month. These blue data points visualize the monthly buyer's execution. Conversely, the Oracle possesses perfect foresight, accumulating capital in an interest-bearing account while waiting for significant market drawdowns. When a major drop occurs, the Oracle deploys all accumulated capital at once and then immediately resumes hoarding cash for the next crash. The red data points track the Oracle's market entries. Look at those results. Over 10 years, the monthly buyer, who blindly bought every single month, ended up with $148,000. The Oracle, with perfect, godlike timing, ended up with $150,000. Think about what this means. An impossible, flawless market timing strategy only beat the lazy, automated strategy by about 1.4%. And remember, that was in Oracle mode. In our other test scenarios, where the investor simply waited for a big drop but could not predict the exact bottom, the monthly buyer easily won. The truth is, in any realistic scenario, constant buying wins. But this is not just about the math. It is about your quality of life. The market timer is stressed. They are glued to trading screens, reacting to daily news, living in a constant state of anxiety. The monthly buyer is completely detached. They do not care what the market does today. They enjoy a high quality of life, spending time with their family and focusing on their career, while their money quietly compounds in the background. This is what it means to be a perpetual investor. The goal is not to make lucky trades. The goal is to build a wealth engine that runs on autopilot. If you want to learn exactly how to build and maintain this perpetual engine for yourself, hit the subscribe button. Stop trading. Start building. Stay tuned to our channel for more data-driven strategies.